Howdy, folks. Welcome to the weekly wrap-up. It is Friday, November 4th, 2022. Hope everybody's having a great day out there in the interwebs. Got some snow here overnight. It wasn't too heavy. Most of it is melted off with the bright Colorado sun that we get out here this time of year. So, but unfortunately, the water department is doing some maintenance out at the street, and they turned my water off. So I went to go upstairs and get freshened up for my video and get my beard all nice and purty, and no water. So it's a little crooked today, so I apologize. Anyways, if it's your first time watching, press these buttons down here, the subscribe and the thumbs up and all that good stuff. I would greatly appreciate it. And I'm sure someone you know would probably get something out of the ramblings that I do on a daily basis. So, and I try to keep this fun. So pretty good day in the markets. Things, the first half of the day, was back and forth in the red and the green and the red and the green. And then, things just took off. I mean, the Dow Jones was up over 400 points today. So, I thought we were probably going to wind up having a negative day after, just the way the week's gone with everything and everyone, down in the dumps because the Fed's not going to stop raising interest rates anytime soon, at least for the foreseeable future. So we shall see. All right, well, let's go ahead and jump into the numbers for today and see how they did. The Dow Jones was up 1.26%. As I said, up 401 points, closed at 32,403. The S&P 500 was up 1.38%, closed at 3771. NASDAQ was up 1.28. They're all up about the same. Closed at 10,475. Small caps are up 0.9. The VIX fell 2.96%. It's currently at 2455. The S&P Canada's market was up 1.08. Brazil was up 1.26. Mexico was up 1.93. Headed over to Europe, Germany was up 2.51. UK up 2.03. France up 2.77. Eurostoxx up 2.65. Netherlands up 1.62. Spain up 0.94. Italy up 2.54. Switzerland up 0.72. And Portugal basically flat, down 0.07. So that's the only red I really see in the big part of Europe. Russian markets both down. MOEX down 0.82. RTSI down 1.3. Headed over to the Asian markets overnight. Japan was in the red, down 1.68. Looks like the rest of the Asian markets were in the green. Australia up 0.5. New Zealand up 0.55. In China, the Shanghai was up 2.43, the SESE component up 3.2, China 50 up 3.67, DJ Shanghai up 2.59, Hang Seng up 5.36, and the Taiwan weighted came in up 0.31%. So, like I said, across the trading day for November 4th, looked pretty solid. I mean, just a couple of outliers that were in the red, but for the most part, a really decent day. So, we'll take them when we can get them. All right, well, let's take a look and see how the indexes did for the week. Let's see here. The Dow Jones is going to finish the week down about 1.08%. The S&P 500, where's the line? Yeah, there it is. Is that it? Yeah. It's going to finish the week down 3.19. NASDAQ, it's going to finish the week off about down 6.34. The Dow Transports looks like it's down 0.37, and the Dow Utilities finishes the week off down 0.79. So pretty much across the board for the major U.S. indexes in the red for the week. Like I said, it looks like NASDAQ was probably the worst. Let's take a pullback and look at, let's start with the S&P 500. And look at the long-term trends so far this year. Again, like I've spoken about, we bumped up against this resistance point on a couple of occasions, got up about halfway to it, and things sputtered out. And so we're back in that downward trend. Same thing with the Dow Jones. Again, we bumped up or even crashed through on two occasions here since August. But, looks like it loses steam. You can look here on some of the other technical charts. We've had crossovers again. Things are trending back down. So, yeah, the MACD did, the momentum indicator did cross over into positive territory, but I imagine it's going to make another short dip like it did back in August. So if I were to put money on it, I'd probably say the downtrend will probably continue for a little bit longer. If it holds up to historical trends, we're probably looking at sometime, early to mid next year before things really capitulate and, the market returns to an uptrend. But again, I could be off. There's a lot of things that can happen. The Fed could chicken out, stop their wage or their rate tightening. And, if they do that, then it's off to the races and, the market's going to probably go up for another year or two and then collapse again, like it is right now. So, all right, let's get rid of that. And let's look at the economic data that came out this week. Let's start out with jobless claims. Initial jobless claims came in at 217,000. Forecast was 220. Last week's number was revised up from 217 to 218, so not too huge. Again, it's in line. I mean, all these, the last few months we've been we've been as high as the 250s, 260s. We've been down as low as the high, 190s. So it's not the end of the world, certainly by any stretch. Continuing jobless claims came in at 1.485 million. Forecast was 1.45 million, so 35,000 over the forecast. Last week's numbers was not revised. So, but again, looking at the trend, we've been in this 1.4, 1.3 million for quite a while now. So, and again, to keep in mind, jobless claims are a lagging indicator. So probably we will see, a lot of companies starting to feel it in their balance sheets before you really start to see the changes in employment. The USM ISM Manufacturing Purchasing Managers Index came in at a 50.2. Forecast was 50. Anything below 50 is a sign of contraction. So we're just above that at this point. So, but again, things aren't great, but things aren't terrible. It's kind of how I put things in a lot of the meetings recently. So, all right. The JOLTS report, the Job Openings and Labor Turnover Survey. There are 10,717,000 jobs open. Forecast was 10 million on the nose. So that we had a reduction the last couple of months. It had dropped down to 10.28, but we then jumped up by about 500,000, more people. So it, again, I'm not totally stressed over it. As long as there's jobs available, that seems to be a pretty good thing. So the ADP Nonfarm employment change, jobs went up by 239,000. They were forecasting 195,000. So that is a decent jump. But these numbers have been all over the place over the last few months, from as low as we had a negative jobs number in February, down as low as 128,000 in June. See, the best numbers were in the, March timeframe. So anyways, all right. Factory orders month over month came in at a 0.3 number. That was right on forecast. Again, some of these numbers, things are contracting right now. So, before they start to go into the red, that's where we really would start to worry. The ISM Non-Manufacturing Purchasers Managers Index came in at a 54.4. Forecast was 55.5, so a bit under what the forecasters were expecting out there. The U.S. employment rate did tick up a little bit this month. We're at 3.7%. Forecast was 3.6. Last month's number was a 3.5. So we're up by 0.2 percentage points. So again, it's not high. As far as unemployment goes, it's certainly a relatively low number compared to, historical trends. If we go back to the 1970s, unemployment has touched 10% a couple of times back in the early 80s. Again, after the mortgage crisis in 8 and 9. So again, it's not the end of the world, but we'll see if that continues to tick up as the year comes to a close. The U.S. participation rate, as far as employment, ticked down again to 62.2%. Last month's number was at 62.3. Certainly better than it was a year or so ago, where it was in the 61 range, but certainly not as good as it was, before the whole COVID stuff got started. We had a pretty solid number of, around 62, in the high 62s and the 63% percentile range. It was actually ticking up in those last few years before COVID. So, Anyways, all right. Well, let's go ahead and dive into our market recap for today. SP 500 gains amid China reopening, optimism, mixed jobs report. The SP 500 rose Friday as investors weighed up a mixed monthly jobs report and optimism about China easing COVID-19 lockdown measures. The U.S. economy produced 261,000 jobs last month, well above the forecast of 200,000 new jobs. The unemployment rate rose more than expected to 3.7. But while this may be welcomed by the Fed, it isn't enough to encourage the central bank to pivot, as other parts of the report showed rising wages and falling participation rate. The stronger jobs report comes just ahead of fresh inflation data next week, which, if continues to show inflation running hot, would lift the prospect of another 75 basis point hike next month. And people in the financial world do not want this to occur. They want to go back to the cheap money, which, again, I don't think it's going to happen anytime soon. But again, I've been surprised by the Fed in the past. Quote, if inflation hasn't started to dip below 8%, then I think the Fed is on tap for another 75 basis points in December, end quote. Tim Courtney, Chief Investment Officer at Essential Wealth Advisors, told investing.com. Treasury yields added to gains, keeping a lid on gains in rate-sensitive sectors, including tech, which is on course to post a 7% loss for the week. Apple fell more than 2%, but Google and Microsoft gained more than 2% and 1% respectively. Materials, however, led the broader market higher as commodities, including copper and iron ore, surged on speculation about China easing COVID-19 restrictions. Newmont Gold Corp, LyondellBasell Industries, and Fremont McMoran Copper and Gold Inc. Rallied, with the latter up more than 10%. Speculation about a China reopening also drove Chinese tech stocks higher, including Alibaba, Baidu, and JD.com. On the earnings front, quarterly results were mixed. PayPal Holdings fell more than 2% as lower full-year revenue guidance amid concerns about slowing economic growth offset quarterly results that beat on both the top and bottom lines. The lower guidance, quote, incorporates consumer discretionary spend slowdown given inflation impacts to non-discretionary items, end quote, Oppenheimer said, though added that PayPal is a strong long-term holding. Starbucks, however, rallied more than 8% after the coffee chain reported better than expected results driven by strength in its U.S. and international businesses. Block also reported third quarter beat on both top and bottom lines, led by growth in its subscriber-based revenues in its Cash app. DraftKings, however, plunged 26% after the sports betting company reported a narrower loss in Q3, but warned of the impact on the consumer demand from a weaker economic backdrop. So, mostly good news today, and next in our next article, we're going to talk about gold and really all commodities were just did tremendous today. Let me bring this up on the screen. Let me make it a little bit bigger so you can see over here on the commodities. Oil was up. Let's see. WTI was up 4.39%. Brent crude was up 3.89%. Natural gas was up. Oh, I'm sorry. Those are the dollar figures. WTI was up 4.98%. Brent was up 4.11%. Natural gas was up almost 8%. Gold up 3.26, silver up 7.78, copper up 8.1%, and soybeans up 1.77. So great day in commodities all around. If you have a decent amount of those in your portfolio, you probably saw some nice returns today. So this, like I said, this article, Gold Rockets, Dollar Plunges, that also has helped the commodity prices. In rare pivot ahead after Heady U.S. jobs report. It sounded almost like one of those allegations of manipulation you commonly hear in gold, only this time those making the accusations were gold bears, not bulls. Gold had its best percentage win in 2.5 years on Friday, as the hedge funds that typically hammer the yellow metal at any given opportunity gave it surprising love after the monthly U.S. jobs report again overshot expectations, a situation that would normally benefit the dollar rather than gold. The dollar index, which pits the greenback against the euro, yen, pound, Canadian dollar, Swedish krona, and Swiss franc, dropped below 111 at Friday's low, despite the United States adding 261,000 jobs last month in its October non-farm payrolls report, almost 35% more than the 195,000 anticipated by economists. Just a day ago, the index hit a 3-week high of 113.035. A U.S. gold future settled Friday's trade up 2.8% as the benchmark December contract finished up $45.70 at 1676.6 per ounce at New York's COMEX. Investing.com data showed it was the biggest percentage win for gold in a day since April 2nd, 2020, when the benchmark contract rose 2.9%. So, but like I said earlier, it's a win really across the board for commodities today. Again, I don't know if it's going to last. The dollar index is a finicky thing. It has a lot to do with the other currencies around the world and how bad they're, manipulating their currency and devaluing it at the same time. So it looks like everyone else is just doing worse than us. Again, the tallest midget in the room at this point. All right. Last article, still strong U.S. jobs report may show weakening in some of the details. And let's read through this. The headline number in the U.S. October jobs report released on Friday shows firms adding more than expected 261,000 jobs, and hourly wages continue to rise, evidence of a still tight labor market. Yet under the hood lie evidence of, quote, softening, Federal Reserve officials say will be needed to slow inflation from its current torrid pace. For only the seventh time in the 30 months since the initial coronavirus lockdowns in March and April of 2020, the number of people considered unemployed increased, rising by 306,000 over September to just over 6 million. That is a low number for the United States and equates to a 3.7% unemployment rate that many economists would say is close to or maybe even below substantial full employment. But the number of unemployed has now risen in 2 of the last 3 months, and the increase in October was particularly notable. In any given month, millions of people change their labor force status, flowing from joblessness to employed and vice versa, and joining or leaving the labor force by starting or stopping a job search or leaving or accepting a job. Those labor force flows are significant in their own right. If unemployment rises, for example, because more people are start looking for work, that can be a healthy sign, particularly in this environment where there are near record number of job openings. That's not what happened in October. The number of actual job losers jumped nearly 300,000 last month to more than 1.6 million, a level above the 1.5 million monthly average over the last year. At the same time, the number of unemployed people who found a job fell to about 300,000 below its yearly average. By contrast, both the number of unemployed who effectively left the labor force by stopping a job search or joined it by starting one were both right at their yearly average in October. The net change, in other words, was driven this time by job loss and shortfall in job finding. On average, over the past year, the number of unemployed has fallen by about 117,000 per month. If that starts to trend the other way, it could both convince Fed officials that their restrictive monetary policy was starting to have an impact, while also intensifying debate over whether they have pushed too hard. Again, these journalists are just hell-bent on going back to 0% Fed funds rate because then money's cheap, makes tech look excellent in their future forecasts, and then they have better future valuations. It's an inverse relationship. As interest rates rise, it hurts their future valuations because and there's a complicated formula. It's been years since I don't do that for a living, so I don't calculate that sort of stuff. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I'll be back on Monday, hopefully, as long as we're all alive and the world hasn't come to an end. And let's go ahead and, again, everybody have a great weekend, and I'll talk to you then. Bye-bye.